Guys, just to give you a quick rundown. So this group that I've designed, it's about educating everybody on what they can do on property. So it's not about selling you anything, okay? This is about educating you on different facets and different opportunities of property that you can do. Now, a couple of days ago, I did ask everyone, listen guys, what do you want to learn about? Because it's a waste of time me sitting here just blabbering on for the next 20, like half an hour or so. It's more about, I want to teach you what you want to learn. So guys, over the next weeks, months, years, whatever, you can always message us on Facebook and want us to, teach you on something in particular, but you can also comment in here as well. So this is a very interactive group. So if you have a question, you can physically comment in this group and then I will respond or someone from my office will respond. And if I think it's really good for other people to watch, that would be perfect to do an actual training event on. So that's what it's about for me, is just making sure everyone understands about property investment, what they can do, and just get ahead financially, guys. So many people don't, and it frustrates me because there's so much opportunity available for everyone out there. So if you have any, oh, you've got Scott here as well. So if you have any questions, guys, I can see comments on a separate device over here. So I will at the end, if you have any questions about what we talk about, I will have that opportunity at the end. I can answer questions independently or whatever it might be. But with my questions I asked, who wants to learn what for this, just for this first event today? Most people just wanted to learn the basics. Like, to be honest with you, they just wanted to learn where are they at? Like a lot of people have dealt with myself and just have done a home loan, for example, and they want to know how are they going to buy a property? How do they buy an investment property? So I'm going to start with some basic things. And basically there's a basic level or beginner, then you've got intermediate, and then you've got advanced or professional investor. So I'm just going to break that down tonight. That's all I'm doing tonight, just for this first one, is break it all down. And it might help you guys generate some more questions that you want to learn about for me to do next week. So guys, very important, two big things. One, please, any questions you've got, fire away in the comments or message us direct that you want us to do a training session on. And two, if you have any family or friends that want to learn and are like-minded like yourself, it's very important that you invite them to the group, because then they'll understand you when you're talking to them about opportunities or what might be. The biggest thing that a lot of people face is they might like a certain style of property investing, but they go and speak to their family and they're all say, don't do that, it's too risky. So, but if they understand and have educated themselves, they'll be behind you and they might actually join you in that property investment journey. So guys, I'm more about spreading the word. The more people out there taking control of their financial future is really all I'm after. All right, guys. So the first thing I wanted to share with you guys is the 3 different levels which we call of property investing. So the first one's basically is the basic, it's the beginner. So if you haven't got an investment property right now, you would start on the beginner level. I'm going to take you through step by step each part. So the beginner level is where you might have, or the basic one where you might have 1, maybe 2 properties. And then you've got the intermediate, which is sort of 2 properties right up to wherever you want to be. It's about locking in your foundation, 4, 6, 8 properties, whatever you want to do. And then you've got the advanced, and then that's more like your advanced professional style investor. All right, guys. So I'm just going to start with the basics. So the first thing that people ask me is, Wayne, how do I buy an investment property? So the first thing you need is equity or a deposit. So let me just share. I've got a little whiteboard here, guys. Bear with me. I've got my iPad. I'm just going to share my screen here on this white pad, for example. And so the 2 main things, guys, that you need to start off with is income, right? The first one's income. Banks are quite strict at the moment with how much income you have got coming in to service the loans and the debts you want to put in place. So it's very important to have a good income coming in. And I do say to a lot of people, if you don't have enough income, try and push your career a little bit further, try and push your income higher. Always ask your boss for a pay rise, because you need that income for the bank to lend you money to be able to start your portfolio. So the first thing you need is income. So what the banks want to see is that minimum 30 to 40% of your disposable income after living expenses, after existing home loans and debts you currently have. They want to make sure you can service that debt. They do add the rental income in as well, but they don't assess your rental income as the same as for example, your personal income. So it's very important that you do, try and push for as highest paid job as you can, to be honest. That's always, just don't tell anyone that works for me that. So the next thing is you either need savings like a deposit. So if you're a first home buyer, savings, okay? If you already have your own home, you really want to have equity. So the best way of doing it is, say here, so the minimum the bank wants is a 10% deposit, right? Okay. So if you're, say for example, you're a first home buyer, but you're not going to worry about any of the first home buyer grants or whatever, you just want to get into the property market, because a lot of people do rent investing. A lot of people do that now, or they rent where they want to live and they save to buy properties as part of their portfolio. So say for example, you've got this property here, we'll just say $600,000. And you need a 10% deposit. So that's pretty basic, right? You get $60,000 over here in savings, okay? And of course, you'd borrow the other $540,000. And the thing I would put in place here is I would make sure that we had a strategy. Okay, so we've used a lot of your savings for this property, but I need a strategy to help you. What are your future plans? So are you going to buy your own home in the future in the short term, or are you going to buy more, just keep buying investment properties? So that'll depend on the loan structure and the structure, like whether you have an offset account, whether you pay the money actually physically off the loan. And of course, I give you ideas, and then you've got to go get your own independent advice just to make sure it's the right strategy for you. So that's the simple way. Okay, first thing is deposit. That's a no-brainer, let's be honest. All right, so the next one is equity. So a lot of my existing members, I've just noticed I've got a lot of existing members on here at the moment as well. They've already got started. So, and a lot of them have used equity. Okay. So with the equity side of it, the bank wants to just make sure that you're under, depends on the lender, under 80% or under 90%, what they call loan to value ratio. So as long as you borrow, so if you had a $600,000 property, as long as you, where are we over here? You might owe on that property, say $200,000, for example. This is your home. And over here, you want to go buy an investment property for $500,000. How the banks assess that is because if you go to buy an investment property, in most cases, even though the property you buy is 520, you'll have a loan, sorry, 500, you'll have a loan of 520,000, okay? So what the bank does is they there's the most common way is they cross securitize the two properties together. So this is your loan here for your home. So you want to make sure when you set up your investment loan over here, this 520, you do want to make sure it's separate. You want to make sure it's definitely not just increase on your home loan, because every accountant will hate you for that, because you want to make sure what is the tax deductibility of the loan and what's the purpose of the loan. So if you're buying an investment property, the purpose is to invest. So that is tax deductible against any income that property produces. So end of the day, what they do is they cross securitize both properties. So the way the bank sees it is you might have, where are we? Just going to make a bit of space here. I'm not going to another pay. No, it won't. What you'll have here is you've got your home is 600,000. The investment property you're buying is 500,000. So that gives you basically $1.1 million worth of asset. Okay. Now with your loan side of things, you have a 520 loan for the investment property, and you'll have a $200,000 home loan. So on paper, you basically owe $720,000. So I'll just double check myself with this one. Yeah, there you go. So that gives you what they call a loan to value ratio of 65, approximately 65%. So as long as you're underneath the 80%, you're okay. Now, some investors, some banks will let you go to 90%, but everything over 80%, you're going to pay mortgage insurance. So anything that you hear, as soon as you go above, that's the shockingness drawing, above 80%, you're going to start paying mortgage insurance. And everyone has to know that doesn't protect you at all, it just protects the bank. So depending on your asset position and your income and the tax deductibility of what you're doing is how you assess, do you do mortgage insurance or do you not? Mortgage insurance is there for a reason. It's there to help you get started buying your first home, and in some cases help you get started and help build your portfolio. I'm huge on trying to only use 10% deposits for investments if you're using cash or savings, because you're able to expand and grow your portfolio a lot more a lot more rapidly, and it's all tax deductible anyway. But it's assessed on a one-to-one basis. Okay, so that's pretty much basic. Okay, so I'm not going to bore you anymore with that stuff. Most people watching, I'm pretty confident, are already know all that. So next thing is what we call an intermediate investor. So a lot of people have asked me, am I an intermediate investor or am I a basic investor? Obviously, if you're a professional or an advanced investor, you already know that. But intermediate and basic or beginner is two separate things. So a basic or beginner investor is still very early in their portfolio. So you might have only ever bought one property. You may have bought two properties, but it depends on the scenario. But normally, once you get to more than one property or more than a couple of years of having a property portfolio, you would call yourself an intermediate investor because you've learned everything involved along the way. So you learned, like, how the tenancy process works. You might have gone through a couple of different tenants. If you bought a couple of properties, you understand the buying process. In some cases, the selling process as well, when it comes to capital gains tax, blah, blah, blah. So intermediate for me, especially in our company here at The Property Bloke, is what we call anyone who's got 2 or more properties. So 2, 4, 6, 8. Who do we appreciate? No, I'm joking, not stupid. 2, 4, 6, 8. Depends on where you want what we call your foundation. So here at The Property Bloke, we're huge on making sure you build your portfolio in a positive cash flow format and also safe. Okay, it's a very important thing to say safe, because an intermediate investor, as they grow their portfolio, it's very important to have, say, your cash flow property and your growth property. Your cash flow property offsets any costs associated with your growth property. Now, you might not build it exactly like that. Some people just do cash flow, cash flow, cash flow, because they want to take that extra, 10, 15, 20 grand a year that each property produces and just rapidly pay down their home loan. But that's their strategy. As an intermediate investor, they're building their cash flow stock in relation to their foundation and using all that tax-free cash flow to pay down their home loan. That is just a strategy. It just depends on your own scenario. So guys, very important though, as an intermediate investor, that you build a safe and strong portfolio. We use our system in here that we follow as a generic style system that we use here. Now, but not every investor that walks through the front doors who meets with me does it exactly that way. Sometimes we'll do just cash flow, cash flow, cash flow. And sometimes we have people that are on a really high taxable income and they need growth because they're more tax effective, because that's what their accountant wants them to do. So each one is very individual. Just keep that in mind. But intermediate for me is where you want to get to start off with. Okay, basics good, but basics not going to get you financially free. Intermediate can get you to retirement financially comfortable. Okay, so an intermediate portfolio, when you get to retirement, whatever age that'll be, 60, 65, 70, whatever it is, that will probably get you an okay lump sum in cash flow that within his super you may be able to obtain. But that's not going to get you into a position to be financially free or control your finances prior to retirement. That is just in retirement. Now, I'm a big believer. I really don't like the word retirement. A lot of people you see that work hard all their life, get to retirement and die a couple of years later. So I'm a big one on, okay, let's work on your foundation and you can stay an intermediate investor, but I want you to try and take control and get a job you love or work part-time or have more holidays prior to retirement. You do have to live your life. You do not want to be a workaholic and just work and just die in retirement and have all this money down to your kids. There's no point. Let your kids fend for themselves. Okay, so that's with intermediate, okay? And then so we've gone basic, which is 1, maybe 2. Intermediate, it's 2+. So 2, 4, 6, maybe 8. I've got many clients of 6 to 8 properties that are just very happy with their foundation and they don't really want to do, or they're not ready for advanced or professional investing. And there's many reasons for that. That could be they still having kids. That's the big one. It could be that they're going through a divorce and they're trying to reset on their structures. There's many different reasons. But guys, when you go into advanced, it's a different ball game. When we go into an advanced and you're taking that jump It's basically crossing the bridge from an intermediate investor into a professional investor. That doesn't happen overnight. That takes a little bit of time. So what we've got to plan that out. Now, anyone with some income, with some equity, they can all retire within a few years if you want to be a professional investor. I'm a big believer. I go all in, okay? But that's not for everyone. I have a very high risk tolerance. So that's just through my 20 plus years of experience with property. I know what can go wrong, what can go right, and I just go for it. And I have a calculated risk every single time. But I'm going to just note down here. I'm not sure. I forgot to say in the beginning, get a pen and paper just in case you want to learn something. But of course, this will stay in our Facebook timeline in the group anyway. So don't stress. You can always go back to it. The benefits of technology are fantastic. So as a professional investor, now obviously I call myself a professional investor, there's different strategies you can do, okay? And I'm going to go through each of these strategies at some point in this training. So say, for example, we've got rent to rent, quick cash, property options, small subdivisions, joint ventures. You can become like a bit of a buyer's agent as well, where you're out there searching for sites and you might have had to afford them, but you can on-sell them as part of a process. Cash flow strategies are a big one as well, because as a professional investor, you're really only going to, retire as such or get real control with cash flow. Quick cash, which is chunk deals, which is where you might buy and sell something on a quick basis, that will give you cash, but it's not going to give you that residual income that you may need. It's very important your portfolio has many things, like residual income's one, depreciation's another one, which helps you offset any tax or capital gains tax. But you need capital, you need growth as well. You need growth within your portfolio. All right. So so a quick cash deal could be where you buy a block of land, put a duplex on it and on-sell the property. Your property option is where you buy property without a normal New South Wales or Queensland, or sorry, I really only focus New South Wales, Queensland or Victoria contracts. You use an option, which gives you the opportunity to get in and get out of that deal really quickly without paying any stamp duty. And then you've got small developments. That might be a block of 3 or 4 townhouses as well. You don't want to go too big too early, of course. Joint ventures is a big one, which I will be doing a lot of training on. Joint ventures is how someone who either doesn't have the equity or doesn't have the income can really elevate themselves in the property portfolio space by using other people to help them grow. And it could be someone in the group right now. So I know our membership group at the moment is a little bit low. The main reason for that was because Facebook blocked me from inviting all my friends, but that's okay. We'll get them all in there eventually. And then, of course, we're talking about got cash flow strategies. Cash flow strategies are important because they help fund any sort of development that you might be outlaying any interest on, any interest repayments across the land or across the building or construction, whatever it might be. All right, guys. So rent to rent, that's a good one that I use personally as well. That's where basically you rent a property and you can sublet, or you can do like a small room house where you sublet the rooms out. Now you don't own that property, you only pay rent. So you might pay $450 a week rent, but you might sublet the rooms out for $900 a week. So obviously you've got expenses, you've got furniture. It's a lot more in detail, which we will go into that one day as well. But what that does is that puts you in a position of cash flow without having to own the property, which is fantastic. Okay. Like at the moment, the rental market is quite strong. So it's a lot harder to get rent to rent. So therefore, as an investor, you move to some other form of investing through that period. Okay. The biggest thing that I always say to people, if you've got one style of property investment in your portfolio, when you become a professional investor, is set up wrong. You need to have 2 or 3 different styles of investing that you're doing, whether it's quick cash, whether it's property options, whether it's rent to rent, cash flow strategies, whatever that might be, guys. Now, I just want to show you. So say for example, a good one for an advanced one is say, what have we got, a duplex. So just give me 2 seconds. I am just going to find something for you here. Bear with me 2 secs, guys. I've got an example here. I'm just going to share my screen. Give me 2 seconds. I've just got to figure out this technology. All right. So this is a prime example of what you can do. Okay. So if I share my screen, I hope you guys can see this moving forward. So this is just a prime example of what we find for our elite members. So we have elite members, which is all our professional people. And this is an example. We've done a costing scenario for a duplex package. The fixed price contract we've got in place is just under the $800,000 mark. It's in Thornton of New South Wales. So it depends on where you're listening from today. This is a Thornton in New South Wales. We've got all the costings involved. So once you build this property though, it's cost you $800,000 to build. And this is 2 side-by-side 4-bedroom duplexes. It's pretty simple. And this one I think was in a brand new estate off memory. Yeah, the Brentwood estate. So what we're able to do on completion, these are worth anywhere from 500 plus. And if they're built with the right quality and the right inclusions, you'll sell them on completion very quickly. So, you know, you might walk away here with less cost. You might walk away with 100,000, I don't know, 100, maybe 150, but of course you've got capital gains tax, etc. Now, if we were to put this together for one of our members, we would teach you on what you've got to do. So if this block of land was existing, there's small strategies like, you know, get an extended period to take ownership on the land, because that's important, because through that next, I don't know, 6 months, 3 months, the biggest things, extended settlements work fantastic when you're in the professional investment market. Through that next 3 months to 6 months, while you don't physically own the land, but you've contracted to it, you can put your plans through council, get them all approved, put it all together, so that when you take ownership, you can start building straight away, get it done. And the same thing with a brand new estate. Sometimes getting extended settlements in a brand new estate is better as well, because you don't want to be the first property finished, but you don't want your land sitting there for the next 3 to 6 months, paying interest as well. So there's different strategies we teach you, which I'll be teaching you in this group as well over the next weeks, months, years, of what you can put in place, guys. All right. So that's just a bit of a rough draft of different levels of investing that what we do here to Property Bloke. So it's not common fact. That's just what we think it is. Now, guys, the biggest thing I want you to do, whoever's watching this now, whoever's going to watch it over the next couple of days as they see it in their newsfeed, is any questions you've got, you can either post the questions directly in the timeline of the group. I'm pretty confident it's a public group, so you're going to be able to do that. If it's not, messages will change it. As you know, the group's only relatively new at the moment. Next thing is you can send us a message directly to us, or you can comment just below in the comments. It's just important that I want to teach you guys what you can do out there, what style of property investing you can do. And I've even got here, I've got young Jack. He's a friend of my son. I've noticed he's watching as well. Hey, Jack. The younger, I love seeing the young guys grow as well. It's very important that I see them grow. I want to see everyone start as early as you can and only invest within the risk levels that you can afford. But guys, one thing actually just popped in the comments, actually, I just seen it. In the comments, if for say, for example, you have some few questions and you want us to have a quick 15-minute chat with me, I do have a free 15-minute chat section where you can book into my calendar for 15 minutes, but just so you know, guys, it is 15 minutes to ask some questions. And yeah, and I can just talk you through what you can and can't do, and just throw some options out there for you. I'm all about trying to give back to the community. And this is how I've started, of just teaching people how to invest in property. So guys, that's about it for the first one. We will be a lot more prepared next week. I just want to get more questions from you guys. I want to know what you want to learn. What would you like me to teach you? And if I don't know the answer, I'll probably will, to be honest with you, if it's around property, but I might be able to get an accountant on, I might be able to get a conveyancer on with me here as well. And even a mortgage broker. You know, I've got a couple of mortgage brokers that refer work to me, and obviously we refer them back. I just want to make sure everyone's learning everything you need to learn to get yourself ahead financially. Even if you don't take action on that for the next 2, 3, 4, 5 years, even though procrastination is a killer, I don't suggest that. I just want to make sure you guys grow. Okay, so this group's about you guys growing financially, yeah, anything, reach out to us anytime. Obviously, I'll give you a couple of details. We've got the email, which is info@thepropertybloke.com.au. Or you can always give us a ring on 1300 322 300 and ask away any questions. But like I said, if you've got just a few questions you want to personally know about yourself, you don't want to put it into the group, just click on that link for a quick, they just put in there for a quick 15-minute chat, guys. But like, thanks again for coming on tonight. And I'm really looking forward to chatting to you guys every Tuesday. So every Tuesday, 7 p.m, I'm going to be doing training in this group on certain subjects. Now, I will release what I'm doing just prior, so you know what it's about. So if it's not for you, you don't have to watch. But if you miss it, of course, we're going to keep it in the timeline. So go back and watch it. And I'm trying to keep it to a maximum of 20, 30 minutes of that training, because as everyone knows, after about 30 minutes, you're going to get bored and you're just going to lose focus. So it's very important that, we just teach you how to put it. I'm going to stop rambling on now, guys. So go and have, kiss your kids good night, go read a book, go and have some, I can't say that on live, but see how you go, guys. If you need anything from us, reach out. Otherwise, I'll see you again on Tuesday. And I'm looking forward to teaching you guys how to put it all together. Thanks again, guys, and have a good one.